Ladies and gentlemen, thank you for being here today. Whether you're a homeowner already or planning to be one in the near future, one thing is certain, your mortgage will likely be one of the biggest financial commitments of your life. It's a long-term relationship with your lender, one that spans years, sometimes even decades, and like any long-term relationship, it deserves regular attention, understanding, and where possible, smart adjustments. Now, we often hear people say, that's just the way it is. Mortgages are expensive. I'll be paying this until I retire. But what if I told you that you might be able to lower that payment, maybe significantly, and save thousands, possibly tens of thousands of dollars over the life of your loan? See, we tend to accept our mortgage as fixed, unchangeable, just another bill we have to deal with. But the truth is, your mortgage is not set in stone. There are strategies, legal, responsible, and surprisingly accessible strategies that can help reduce your monthly payments and lighten your long-term financial load. Today, I want to walk you through 3 of those strategies. These aren't gimmicks. They're time-tested, financially sound methods that many people either overlook or don't fully understand. And I believe that with the right knowledge, you'll be in a much stronger position to improve your financial future. Let's start with one of the most powerful tools available to any mortgage holder, refinancing. Refinancing simply means replacing your existing mortgage with a new one, often with better terms. It might sound like a hassle, but depending on your situation, it can be incredibly worth it. For example, if interest rates have dropped since you took out your mortgage, refinancing to a lower rate could shave hundreds off your monthly payment. Even a 1% drop in interest can make a significant difference over time. On a $300,000 mortgage, that 1% could reduce your monthly payment by over 150. Multiply that by 12 months, then by 30 years. That's tens of thousands of dollars saved. But refinancing isn't just about interest rates. It can also allow you to change the term of your loan. Say you originally took out a 15-year mortgage, but now find the payments a bit too high. Refinancing into a 30-year mortgage will reduce those monthly payments and give you more breathing room. Of course, you'll end up paying more in interest over the life of the loan, but if your primary concern is reducing your monthly expenses and improving cash flow, it's a viable option. Now, I know what some of you may be thinking. Doesn't refinancing come with costs? Yes, it does. Closing costs, appraisal fees, and other associated expenses can add up. But many lenders offer no closing cost refinance options where the fees are rolled into the loan. And even when you do pay fees up front, the long-term savings often outweigh the short-term costs. The key is doing the math, looking at your break-even point. That is, how many months it will take before your monthly savings equal the cost of refinancing. If you plan to stay in your home longer than that, refinancing could be a smart move. Next, let's talk about property taxes. Most people assume these are just fixed costs they can't do anything about. The county sets the value, the tax rate is applied, and that's the bill you pay. But here's the thing, property values change, markets fluctuate. And sometimes the value your county or city assigns to your property isn't accurate. It could be inflated. That means you're paying more in property taxes than you should. Many homeowners don't realize they have the right to appeal their property tax assessment. If you believe your home has been overvalued, you can gather evidence, comparable home sales in your area, a professional appraisal, recent renovations or lack thereof, and file a formal appeal. If successful, your assessed value gets lowered, and so does your property tax bill. And since many mortgages include property taxes in escrow, lowering that bill directly reduces your monthly mortgage payment. The appeal process varies by location, and yes, it takes time and a bit of effort. But think about this. If a successful appeal saves you even $1,000 a year in taxes over the life of your mortgage, that's a savings of $30,000 or more. Not bad for a few hours of paperwork and research. Some areas even allow you to do it entirely online. And one more thing, keep an eye on your escrow account. Sometimes your lender overcollects for taxes and insurance. If your escrow balance consistently runs high, ask for an escrow analysis. You might be due a refund or at the very least a reduction in your monthly escrow payment, which lowers your total mortgage bill. Now, the third strategy I want to share is one that takes a bit more commitment, but it can be incredibly effective: recasting your mortgage. Recasting is when you make a large lump sum payment towards your mortgage principal, and then the lender recalculates your monthly payment based on the new lower balance. The key benefit? Your loan term stays the same, your interest rate stays the same, but your monthly payments drop. Let's say you receive a bonus, an inheritance, or you've been diligently saving and have $20,000 you can put toward your mortgage. By recasting, that money goes directly toward reducing your principal, and your lender adjusts your monthly payment accordingly. The result is often a significantly lower monthly obligation without the costs and paperwork of refinancing. Not all lenders offer recasting, but many do, especially for conventional loans. There's usually a small fee involved, maybe $250 to $500, but again, the long-term savings can be substantial. What I love about this option is that it gives you flexibility. Unlike refinancing, you're not taking on a new loan. And unlike simply making extra payments, which reduces your loan length but not your monthly obligation, recasting actually reduces the amount you're required to pay each month. It's like customizing your mortgage to fit your life as it evolves. And here's the powerful part. These three strategies, refinancing, appealing your property taxes, and mortgage recasting, can be used together. They're not mutually exclusive. Imagine this scenario. You refinance to a lower rate, appeal your property taxes, and succeed. Then later, recast your mortgage after a financial windfall. Each step chips away at your monthly payment, your total interest paid, and ultimately your financial stress. That's the goal here. Not just saving money, but buying back your peace of mind. Because every dollar you don't have to send to your lender each month is a dollar that can go toward your future, toward retirement, your children's education, travel, investments, or even just building up a cushion for life's inevitable surprises. Too often we feel stuck in the systems we're handed. The bank says pay this much, the county says your home is worth this much, the loan schedule says you'll be done in 30 years, but knowledge gives you leverage, and leverage gives you options. Some of these steps might seem small. Appealing your tax bill doesn't sound dramatic. A refinance sounds like something you'll get around to eventually, but small steps add up. That's how compound interest works. And ironically, it's also how compound savings work. 100 here, 200 there, repeated over months and years. Suddenly you've got the freedom to breathe easier, plan bigger, live better. Of course, none of these options are one size fits all. Your financial situation, your mortgage type, your lender's policies, and your local tax rules all play a role. But that's why it's worth asking the questions. Calling your lender, running the numbers, talking to a financial advisor if needed because you have more control than you think. If there's one thing I hope you take away from this talk, it's that your mortgage doesn't have to be a burden you carry quietly for decades. It can be a tool you manage, a system you optimize, and yes, even a source of savings if handled smartly. The world of personal finance often feels overwhelming, and mortgages are right at the heart of that stress. But the truth is, with the right information, a little effort, and a willingness to take action, you can turn that stress into strategy. You work hard for your money, every paycheck, every hour. Your time and energy have value. Don't let thousands of those hard-earned dollars slip away because no one told you how to save them. Don't let your mortgage control you. Learn it, manage it, take control of it. Lowering your mortgage payment might seem difficult, but there are practical strategies that can save you hundreds each month and thousands over the life of your loan. Many homeowners don't realize that their mortgage terms aren't necessarily fixed forever. With the right information and action, you can take control of your loan and reduce your financial burden. One of the most effective methods is refinancing. If interest rates have dropped since you got your mortgage, or if your credit has improved, refinancing can get you a lower interest rate or extend your loan term to reduce your monthly payments. While there are some closing costs involved, the long-term savings can be substantial, often tens of thousands of dollars over the life of the loan. Another strategy is to review your property tax assessment. Property taxes are often included in your monthly mortgage payment, and they're based on your home's assessed value. If your property has been overvalued by your local tax authority, you may be paying more than necessary. You have the right to appeal that assessment, and if successful, your taxes and your monthly payments will go down. It takes some effort, but the savings can really add up. A third way to lower your mortgage payment is by recasting your loan. If you receive a bonus, inheritance, or have some savings, you can make a lump sum payment toward your mortgage principal. Your lender can then recalculate your monthly payments based on the reduced balance. This is a simple, often inexpensive process that can bring down your monthly bill without refinancing. Each of these steps can lead to real savings, and when used together, they can make a dramatic difference in your financial future. Small changes today can lead to big results tomorrow. Lowering your mortgage payment is not only possible, it can be surprisingly simple if you know what options are available. The first and most common method is to refinance your mortgage. Refinancing means replacing your existing loan with a new one, ideally with better terms. If interest rates have gone down since you took out your mortgage, refinancing can lock in a lower rate, which directly reduces your monthly payments. Even a 1% drop in interest can save you hundreds each month and tens of thousands over the life of the loan. You can also refinance to extend your loan term, say from a 15-year to a 30-year mortgage, which reduces your monthly payment by spreading it out, although it may increase the total interest paid. There are closing costs involved, but many lenders offer low or no-cost refinancing options. The key is to calculate your break-even point to make sure the savings are worth it over time. The second way to reduce your mortgage payment is to challenge your property tax assessment. Property taxes are often included in your monthly mortgage payment, and they're based on your home's assessed value. But assessments aren't always accurate. If your local tax assessor has overvalued your property, you're likely paying more than necessary. You have the right to appeal this value. By providing comparable sales data, photos, or even a professional appraisal, you might succeed in lowering your assessed value and with it, your property tax bill. It's a process that takes time and documentation, but it can lead to permanent savings year after year. Even small reductions in property taxes can lead to noticeable changes in your mortgage payment, and those savings compound over time. It's one of the most overlooked strategies, but also one of the most effective. Another highly effective but often overlooked way to lower your mortgage payment is by taking advantage of mortgage recasting. Unlike refinancing, which involves replacing your loan, recasting keeps your original mortgage in place but adjusts the monthly payment based on a reduced loan balance. The process begins when you make a large lump sum payment directly toward your loan principal. After receiving the payment, your lender recalculates your monthly payment amount based on the new lower balance while keeping the same interest rate and loan term. This results in a smaller required monthly payment without the need to reset your loan or pay the often high fees associated with refinancing. Recasting is especially useful if you come into extra money such as a work bonus, inheritance, proceeds from selling another property, or simply accumulated savings. By applying that amount towards your mortgage and requesting a recast, you can significantly reduce your monthly financial burden. For example, applying a $20,000 lump sum to a $300,000 mortgage can lower your monthly payment by hundreds of dollars, depending on your interest rate and remaining term. The beauty of recasting is that it's a one-time effort with long-lasting impact. Unlike making extra payments alone, which reduces your loan balance and shortens the term, but doesn't lower your required monthly payment, recasting actually resets your monthly obligation at a lower level. This can provide much-needed cash flow relief while still helping you pay off your mortgage faster than scheduled if you continue making the original payments. Not all loans qualify for recasting, and not all lenders offer it, but for those who do, the process is usually simple, with a modest fee that's far less than the cost of refinancing. It's a quiet but powerful tool to give you more financial freedom and long-term savings.